Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at applied digital.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For anyone tracking the AI infrastructure boom, applied digital is a must-watch.
It really is.
The core of their story isn't just growth. It's a massive, and I mean intentional, business transition. They have pivoted almost entirely from being, a primary crypto hosting company to establishing themselves as a leading provider of dedicated North American AI data center capacity.
And that shift is everything. It's the whole reason for the hype.
It is. It's the foundational driver of their recent stock performance.
That pivot is so crucial because we're not just talking about a change in strategy on paper. We're talking about an inflection point you can see, clearly see, in the financial results.
You can. The proof is right there.
It's in the latest revenue figures. Their fiscal Q1 2026 revenue jumped a spectacular 84%, hitting $64.2 million.
Yeah.
That acceleration is a direct result of activating their capacity for these new high-value hyperscale AI contracts.
Exactly. And when we talk about hyperscale clients, you have to remember we mean the global tech giants.
The big ones.
The AWS, the Google, the Microsofts of the world. The ones who need staggering amounts of capacity for training these huge AI models.
Right.
Applied Digital isn't just chasing small contracts. They are playing in the big leagues now. They've locked in total long-term contracted revenue streams that now exceed $16 billion.
$16 billion.
Across more than 600 megawatts of capacity. Just think about that number for a second. $16 million in contracted revenue versus their current market cap of what, around $6.7 billion?
That's a massive lever. That security is impressive, but, all that infrastructure has to be funded. Building these multi-megawatt data centers isn't cheap.
Not at all.
We saw consistent revenue growth in 2025, hitting about $144 million, but they also reported a significant net loss for that year, over $233 million.
Right.
This is the classic high-growth conundrum, isn't it? Burning cash today to achieve scale tomorrow.
That's absolutely correct. And those net losses are an intentional cost of doing business right now.
It is. Well, it's all down to the heavy upfront capital expenditure required for the data center build-out.
You got to build it first.
You have to lay the fiber, secure the power, buy the specialized cooling, and construct the buildings before you can recognize a single dollar of recurring revenue from the lease.
So how solid is that trajectory toward profitability? Investors are comfortable with losses only if there's a clear path to turning on the cash flow tap.
The outlook is very strong, assuming, and this is a big assumption, that execution goes according to plan. Margin expansion is highly anticipated as the new capacity comes fully online.
Once those fixed costs are covered by the contracted revenue streams, operating leverage kicks in hard. Analysts are projecting a sharp turnaround, forecasting positive free cash flow beginning around mid-2026.
So that's the key date, mid-2026.
That's when the thesis transitions from a pure growth story to one focused on financial efficiency and, servicing that debt.
Let's discuss that capital structure then. They recently had a very significant financing move.
They did. This past November, the company announced the pricing of $2.35 billion in senior secured notes due in 2030.
And that debt is earmarked specifically for
funding construction at key sites like the massive Ellendale campus and ensuring they can deliver these high-performance AI-enabled data centers on schedule.
A $2.35 billion debt issuance is a huge move for a company this size. And while management has stressed they have abundant liquidity, we need to consider the structure of that debt. The offering received a B+ credit rating with a positive outlook from S&P Global. The positive outlook is good, but B+ is still non-investment grade. Doesn't relying on high-yield debt at this scale introduce a major risk, especially if global interest rates stay volatile?
That's a vital, critical question, and it really speaks to the risk-reward balance here.
Right.
The credit rating reflects the risk inherent in, capital-intensive construction and growth. However, the positive outlook attached to that B+ rating that shows that S&P Global believes the enormous backlog of $16 billion in contracted revenue substantially de-risks the investment.
So the backlog acts as collateral.
In a way, yes. It provides revenue visibility that traditional high-yield debt just doesn't have. The market is betting on the cash flow from those contracts starting in 2026 to service the debt comfortably.
That connection, the contracted revenue validating the debt structure, is the key insight there. Okay, so let's pivot to their competitive edge. Why are these massive blue-chip hyperscale clients choosing Applied Digital over established giants? What is the company's moat?
The moat boils down to three core advantages: geography, cost, and specialization.
We'll start with geography.
They have made a very strategic play by locating their major campuses, particularly in the Dakotas.
Right.
This gives them unparalleled access to some of the lowest cost, most reliable, and increasingly renewable power sources in North America. When you're running thousands of AI accelerators, the cost of power is your single largest operational expense.
It's everything.
Lowering that cost significantly is an immediate, lasting advantage that competitors in Silicon Valley or Northern Virginia simply can't match.
And their sustainability credentials tie directly into that, especially for clients with strict ESG mandates.
Precisely. They are building facilities with state-of-the-art energy efficiency. Their projected power usage effectiveness, or PUE, is an extremely low 1.18.
For those unfamiliar with PUE, could you quickly explain why 1.18 is such a big deal?
Certainly. PUE measures how efficiently a data center uses energy. It's the ratio of total facility energy to IT equipment energy. A PUE of 2.0 means that for every watt used by the servers, another watt is just wasted on cooling and lighting.
And most older centers are what, 1.5, 1.8?
Exactly. Hitting 1.18 is near world-class efficiency. Combine that with near zero water consumption, and this makes Applied Digital extremely attractive to massive corporations trying to minimize their carbon footprint. They're offering a unique package.
Low-cost power, high-efficiency design. Got it. Okay, let's move to the technical momentum for the traders listening. This stock has been volatile, but the trend is undeniably up. Shares are up 203% year-to-date.
The technical setup confirms the fundamental shift. Trading around 24.73, the stock is healthily positioned above its 50-day and 200-day moving averages.
Which is classic confirmation of a strong uptrend.
It is, and the momentum indicators are supportive. The RSI and the MESCD suggest that while the stock has run a lot, the uptrend is not yet exhausted. There's institutional accumulation happening.
What are the key levels investors need to monitor right now?
On the downside, strong support has formed in that $17 to $20 range. That serves as a crucial area for accumulation on any dips.
And on the upside?
Resistance is currently sitting near $30, but based on analyst modeling of the revenue ramp-up, technical upside could extend quite far, potentially toward $40.
We have to talk about the volatility, though. This stock has an astonishingly high beta, clocking in at 7.06. For our listeners, beta measures a stock's volatility relative to the broader market. A beta of 7 means this stock theoretically moved 7 times faster than the S&P 500.
That's a crucial point for risk management. That massive beta means Applied Digital is essentially a pure-pay sentiment vehicle for the AI infrastructure theme.
So if there's good news from NVIDIA, this thing flies.
It flies. Conversely, if there's a macro downturn, a tech correction, or fears about interest rates, the stock will fall much faster and harder than the rest of the market. It requires a high risk tolerance.
Yet, despite that volatility, analyst sentiment is universally bullish.
It is. The consensus is a strong buy rating. The average price target is $29.36, suggesting about 24% upside from here.
Yeah.
But the high targets are ambitious,
Ambitious.
reaching $40 and even $42.90. And this confidence is backed by substantial institutional buying, which we've seen all year. Big funds are allocating capital here.
So let's look at the catalysts. What should investors be watching for in the next few months? What could drive the stock toward those higher targets?
We have three key near-term triggers. First, the closure of that massive $2.35 billion notes offering is imminent this November.
Which solidifies their capital.
For the next 12 to 18 months of construction, yes. Then there is the big earnings event.
Right.
The next report, forecast for February 10th, 2026, is critical. This is where we should see the first major demonstration of recognized revenue from those AI contracts.
So meeting or exceeding expectations there will be huge.
It will validate the entire thesis. And finally, operational news. Management has been hinting strongly at ongoing success.
More contracts, more capacity.
We are expecting imminent announcements about more capacity expansion, new tenant signings, and crucially, the phased opening of new data centers. Proof that they're delivering on time can instantly send the stock soaring.
Before we conclude, let's just quickly touch on the inherent risks again. We talked about debt, but what about execution?
Execution risk is paramount. They are under immense pressure to continuously land and ramp new clients exactly as expected. If they miss a construction deadline, that immediately pressures revenue targets.
And they must contend with giants.
Absolutely. The data center business requires enormous capital. Larger, established players are constantly looking to take that hyperscale business. Applied Digital needs to maintain its cost and efficiency advantages to keep its lead. So if you're looking at Applied Digital, you have a unique confluence of factors: strong growth acceleration, high institutional confidence, and a series of near-term catalysts. This positions the company well for both short-term tactical gains and as a foundational long-term investment in AI infrastructure, provided they can successfully manage that significant execution risk.
Given the intensity of the competition and the high capital requirements necessary to maintain their advantage in the data center space, how crucial will their next quarter's project completion guarantees be to maintaining that aggressive tactical upside potential toward a $40 price target?